Hey traders, this is my weekend video. Some quick things that I'm looking at. So Friday we had a monster negative gamma rally for the SPX, and the reason largely driven by the SPX, and then all the other stocks and stuff just drifted up with it. Basically, when the SPX moves, all it lifts all ships. Okay, because it's such a monster of a index. Okay, so basically that's what happened Friday. So some things I do want to point out here. First of all, okay, there is a default study. It's called the market maker move study. You put it on the daily time frame, and typically it will automatically draw out the expected move for the week. Okay, so you're coming into the new week. You already know where it's all automatically drawn out. A big thing that I've learned over the years, SPX will not, it will not draw it outright. You have to manually draw out the expected moves. You can use the close price off that study, okay, the white line, but do not trust the white and the green and red lines. Those are not accurate. Now, how do you do that in hindsight? Let's say like you get in the middle of the week and you realize, hey, I want to really zone in on this SPX at the end of the week. What you basically do, you go up to your analyze, you come up to here, okay, and the prior Friday, wherever we closed at, you put that date in right here, okay, whatever that date was. So you just go down here on your calendar, and so that prior Friday, excuse me, uh, was the 20th. So see the 20th right there. So you just type that in there, or you could even use the 22nd, but you just type that in right there, okay. And for some reason, I don't know why. There you go. SPX to 20th. This is the last price on that date. Okay, it updates it. Okay, and then you want to know. You want to know. Go down here on your calendar here real quick. So you're looking for the 27th. Okay, the 27th. Okay, so you have to come down a little bit here because you have right there's your 27th, $124.25. Okay, so you take those two numbers, and you can either manually do it with a calculator, or you can have Google has on the Google Cloud. They have a free version of a spreadsheet, or you can just make your own little spreadsheet, put the closing price, put the expected move, then you add and subtract, and that will give you take the expected move, add and subtract it off of the closing price, and that will give your bearish expected move and your bullish expected move. Okay, and then what you do after that, you just transpose those actual numbers, physically draw those trend lines on your chart. Okay, guys. So any of you guys have never done that before. Okay. Then after you do all of that, you take that close. So basically, what we had going on into Friday, we literally were gapping out above that expected move scenario, immediately out of the gate, creating a negative gamma squeeze scenario for anybody, which SPX is a major trading instrument. Immediately create a negative gamma squeeze scenario for causing forced buying in the market. Yes, not for forced selling. When it's a negative gamma squeeze, it's a forced buying scenario. They were literally being forced to cover their short positions. Basically, bottom line is a lot of traders did not expect the markets to go up, like they did, and so they went and sold SPX. They sold SPX call options into the public, not thinking that the prices were going to get that high. Well, all of a sudden they have negative gamma risk now, because all of a sudden it came up to their levels, or blew through their levels, because we're above the expected move. Now they are forced to buy back, those positions, and and it causes a short squeeze to the upside. This is a textbook short squeeze scenario in the markets. And it was all largely caused, most of Friday's action was caused because of what happened in SPX. It wasn't necessarily what was happening everywhere else. It was all SPX, causing this. And how do I know that? Because you can go over here to your trade tab on SPX. The sizzle index on that is almost 5 times the normal sizzle. Okay, and we don't really have a directional trade. Okay, that's another little takeaway too. It's not really a directional. They're not positioning themselves on a huge directional move. They're just being short squeezed to death in this index. So that's basically the fizzle. When the sizzle's almost 5 times, that means you're getting 5 times the normal volume in theory. So on these options, because all these people are trapped and they're being forced to trade these back, get out of these positions. It's a forced scenario. And if you go on here's my sizzle scan for the main indices. Okay, SPX will never show up on any type of scan because of the nature of the instrument. But what you can do here is also on your sizzle index, you see what's going on here. The only thing, see, options on futures, there isn't that much volume on that. So it's not a big deal to see a really high sizzle index on options related to your futures contracts. Okay, anything related to that. Okay, but you see how the highest we've got on regular equities is 3 times. So it was all about the SPX there Friday. You could clearly tell it was a massive, massive gamma squeeze that just ran over the option makers. Okay, and it forced those prices higher. Now, are we going to continue higher? Well, quite possibly. Futures right now are up. Remember, the global markets were open today. Memorial Day is a U.S. holiday. It is not an international holiday. Okay, and if you just go over here to my futures, where's futures at? Futures right here, right now. And what we got going on here on our futures, let me get it sorted right here. Where's the volume at? There it is. There we go. We'll come down here on the volume. And as you can see, we're up 124 points right here, right now on the NQs. We're up 21 points on the ESs. So we are getting a continuation. Basically, the rest of the world was catching up. Plus, we had good news out of China. So in my opinion, the next real bull market, probably for the rest of the year, is Chinese equities. So just keep that in mind too. I've been watching the KWEB. They're starting to talk about it on CNBC and stuff. This thing here is due for a bounce. News is out. They're getting ready to reopen all the major cities there in China. They seem to think they've got the COVID thing under control. I still think this is more related to the tariffs. I think they were trying to create supply chain disruptions, to get Biden to back off of some of these tariffs, which I think he's going to do here in the next week or two. Okay. And look at this, the global markets are all rallying in the face of all-time high German inflation data that hit this morning. The markets didn't care. The markets, they just, the markets are up in the face of that. I think the markets think, the inflation, we're nearing a cap on that. Now, another thing that could actually dramatically, possibly even cause some deflation instead of inflation, if the federal government seriously comes in and lowers for say 2 months, gets rid of the federal tax on gasoline. And I know our local state here in Indiana, we're on the verge of doing that. We're doing away with all state taxes for coming up here in the not so distant future here in Indiana. Okay, so basically, if I am floating this idea out here, if the federal and state can eliminate those taxes on gasoline during July and August, maybe even September, that gets us through hurricane season. Okay, so that's the biggest risk we got going on here, is some sort of weather related, in my opinion, disruption in the supply chains. And we're coming into that, and we're already over 100 degrees in Texas. The Gulf is abnormally warm already for this time of year. So, this is a scenario that, we just want to keep an eye on the news going forward here. If the government's going to be proactive, eliminating those taxes would be actually pretty good for the whole gasoline scenario going forward. So I do want to float that idea for people. It's not that we're getting gas a lot cheaper. It's being able to make sure gas prices don't go any higher, in my opinion. If they can figure out a way to where we don't get over $5, we kind of don't move past this $5 a gallon range for any type of extraneous circumstances. I think the markets will be fine. Okay, so we'll just keep that in the back of our minds. That's a scenario that I've got floating here. Something to think about. Oh, let's see here. I'm trying to stop this video. I can't find it. So another little factoid I want to point out, guys. We went past a 2 standard deviation move to the upside here. So they were just getting destroyed here on that squeeze here on the SPXs. And we're going to be most likely gapping up. So heads up on that going forward into this week. So some scenarios I'm looking at here. I'm looking for a back test of the 50 SMA here. That's 44.40 here on the SPX. That's what I'm really looking at. A lot of times what you see this primary chin channel. We have the breakdown here. We come back and back test it, and that might set up a much deeper leg lower. Or we might actually still be putting in new all-time highs. Okay, so some main takeaways that I'm looking at here: XLF. XLF is not confirming relative weakness. Okay, in the final stages of a bull market, you typically see your XLF starting to lead the markets lower. Okay, and we do not currently have that scenario, so just keep that in mind. Also, another scenario which we typically have. One second here, let me pull it up. Okay, as the Fed raises interest rates to slow down the economy and stuff, what you will typically see is the front end of the curve, this end right here, all of a sudden causes an inversion of the yield curve, where the front end of the curve gets higher yields than what you have on the back end. Okay, this is the back end. So let me show you which time frames those are here real quick. There you go. You got your 1 month. These are your different time frames on these maturities in the bonds. And basically, this front end typically, as the Fed's raising rates to combat inflation, these yields come up, they invert, and that is a major warning sign that we might be starting the next phase, starting the final phase in a correction in the market. We don't have that right now. So just keep that in mind going forward. Now, this may not hold true with if and when the Fed decides to reduce their balance sheet. This is going to have a distortion to this scenario because, taking M2 out of the money, out of the economy, that's another way the Fed can dramatically, attack inflation. So unfortunately, historically, the inversion of this yield curve is a powerful warning tool. But now, since we have the balance sheet also, you have to put both of those. You have to consider both of those scenarios in tandem and see if the combination of the two, are working, for a much greater correction in the economy. Another thing I do want to point out here is the Dixie dollar index. If I am right, and we see Biden come in, reduce the tariffs against China, which I think that's exactly why they've been prolonging this lockdown scenario, in my opinion. And then plus the fuel tax thing, if they do manage to do that as well. I think these are bearish developments for the dollar. as basically you got less revenue coming in for our economy, less tax revenue coming into the economy. So this could be a potential bearish scenario for the dollar. So just keep that in mind as a international trader. A strong dollar, you know, uh, you know, uh, a strong dollar is good as an international investor to come into U.S. equities. If the dollar starts coming off in any type of meaningful way, foreign investors they're losing money the longer they stay in U.S. dollars. So they might find it more advantageous to say rotate to China, which China stocks have just been obliterated. Most of the Chinese stocks are down 80%. So we might be setting up for a scenario where you're going to see rotation out of dollar denominated equities and into even you can make the case for Europe, uh, but basically a weakening dollar is not necessarily a advantageous for global investors. Okay, here we get trapped in here as we're already trading in dollars. Okay, I'm just saying, just keep that in the back of your mind that we would be starting a rotation into international the emerging markets and stuff like that. We might be starting to see a rotation back into those areas here in the not so distant future. Okay, a couple final things, thoughts here and stuff. What I saw happening here, going into the last 4 hours, okay, into OPEX, that was 2 weeks ago, Friday. And so bottom line is the red represents the number of contracts being sold on the ask. Okay, the green represents the number of contracts being sold on the bid, and then I have total volume on my indicator right here. So basically, we saw going into OPEX there, the VX futures were being dumped on the ask to close out the OPEX. Just 2 weeks ago, 2 Fridays ago. Okay, since then, here on the 4-hour chart, look at this. Above average, we got we're below average volume, but the volume we are getting is highly correlated to selling on the ask, selling on the ask, selling on the ask, selling on the ask, selling on the ask. With the exception, we've only had one 4-hour time period in the whole past week that actually saw buyers coming in. So of all the time periods from last week, there was only one 4-hour time frame that actually saw some VX buying, on the bid. Okay, so I do want to float this going forward here. Going at there has not been an appetite in the VX futures since OPEX closed. So just keep that in mind. Big money at these prices aren't not putting on additional insurance going forward. So just be aware of that scenario. And then also keep in mind for the past week, we've had a below average volume, clear below average volume on the VX futures. Like I said, we're getting confirmation of all the trades on the ask, plus all the volume that is hitting into those VX futures. Now, on the flip side, VIVIX, VVIX, this is the volatility of the VIX. If you go out here on the weekly, I mean, they have just decimated this. So, they just do not seem to think that, look at the levels we're at right here on the VIVIX, the volatility of the VIX. So they are crushing this to pieces here. Just not an appetite at these price rate levels at all for additional insurance. Okay. So just, that's what VIX is for. VIX is telling you that big money is putting on insurance because they're worried. Well, both the VIVIX and the VX futures are telling us they are not putting on additional insurance, suggesting we could actually have some higher legs here in the market. So just be aware of that scenario. Okay, my one, I don't generally put individual stocks. I love trading Boeing. Boeing is one of my favorite stocks. So I personally, which I don't know what the final numbers are going to be, I think we are going to have 20-year high travel numbers coming out after this weekend. So I do want to float that. The weather is beautiful. I know gas prices are high, But that's what I am thinking here in going into data. Data is going to be coming out tomorrow of how much travel was going on, how much flying and all that stuff. So I do think this is going to be an extremely hot travel and leisure season for this summer. So keep that in the back of your mind. I had mentioned in the trading room that I actually expect in the next 2 weeks $150 a share back on Boeing. News was out. Norwegian Airlines ordered 50 more planes from Boeing. That came out today. So keep that in mind. Also, I got Boeing is just really one of those that I'm just stalking right here. I am on a 4-hour buy signal on Boeing, so let's just keep an eye on that one there going forward here. I mean, of course, it's up to the markets. If the markets, if this is the fool's errand and we're just bear flagging in a longer time frame, that's fine. I think there's still more upside in the markets, so I'm going to stick with that. Okay, guys. So there you go. Please like my video if you like it. Please retweet me on Twitter, Gumby9662C, if you get a chance. And, leave some comments below if you're seeing something that I'm not seeing. Everybody knows I'm a perma bear, okay? So for me to flip the page like this, this is a big deal for me. So guys, so just well, we'll see what happens here going forward. Okay. So thanks for listening, watching my videos.